I'm Rick Kaler. Thanks for joining me. Well, are your investment returns beating the market? It's a very common question, but it's not as easy to answer as you might think. First of all, the market isn't easy to define. There's many markets. The one market that most people mean when we say the market is comparing your investment returns to the Dow Jones Industrial Average, which is an index made up of only the 30 largest companies in the U.S. The S&P 500 is another common index, which is made up of the 500 largest companies in the U.S. Well, if your portfolio is properly diversified, it's going to include a much broader range of asset classes than just 30 or 500 U.S. companies. My preference is 8 or 9 different asset classes held in index funds for the most part. A typical mix might include stocks from large, medium, and small companies, even micro cap companies, which are very small companies that are located both in the U.S. and in foreign countries, emerging markets, developed markets. There's international bonds, both U.S. and international bonds, which would make up that bond class. There's real estate investment trusts that hold real estate, and again, that can be globally from around the world. Commodities like wheat, gold, and oil. Market neutral funds like managed futures and high yield bond funds and treasury inflation protected securities. Now, that's a lot of different asset classes. It's not really relevant to compare quarterly returns on such a diversified portfolio to the Dow Jones or the S&P 500. And yet, it's the standard when you look at the financial press. So instead of doing that, many professionals recommend a 4-part method to evaluate your portfolio's performance in a much more meaningful way. The first is to take a long view. The changes you see in a monthly or quarterly investment statement are purely the result of random movements in the market. Professionals call this white noise, but you might be surprised to know that even one-year returns fall into the white noise category. It's better to look at your performance over 5 years or more. It's better still to evaluate through a complete market cycle. That's from, say, the start of a bull market to the start of a new bull market. The last bull market started in 2009. However, remember that there are no clear markers on the road side of this road that say this line marks the start of a new bull market. Typically, you don't know that for a number of years. And you often don't know that a bear market started for many months. Number 2, compare your performance to your goals. Suppose your financial plan indicates that your investments need to generate 2% returns above inflation. So if inflation is 2%, that would be 4%. In order for you to have a good chance of affording a long, comfortable retirement. If that's your goal, chances are your portfolio is not designed to beat the U.S. stock market. Instead, it represents a best guess as to what investments have the best chance of achieving that target return through all the inevitable market ups and downs between now and your retirement date. If your real returns are negative over 3 to 5 years, that means you're probably falling behind on your goals and you might be taking too much risk in your portfolio. Number 3, recognize that some of your investments will go down even in strong bull markets. The concept of diversification means that some of your holdings will inevitably move in opposite directions, return-wise, from others. Ideally, the overall trend will be upward. The investments are participating in the growth of the global economy, but not at the same rate and with a variety of setbacks along the way. If you see some negative returns, understand that those are the investments you're counting on to give you positive returns during the times when the other parts of your investment mix turn downward. And finally, when you look at your portfolio statements, don't focus only on the bottom line. Remember that the actual account total is only a snapshot showing the value of the account on one given day. That value constantly fluctuates, sometimes slightly and sometimes more widely. Instead, make sure the investments listed are what you expect them to be. Look at the longer time periods rather than the monthly or even quarterly changes. Notice which investments rose the most and which were down, and you'll have an indication of the overall economic climate going on in the country. Maybe your overall portfolio beat the Dow this quarter or over this year to date. Maybe it didn't. Either way, that Dow doesn't make up a huge percentage of your portfolio if you're diversified. And the variation in your portfolio still only represents white noise. Thanks for joining me.